Good evening. Welcome to Personal Finance. Okay, so what we're going to talk about tonight are stocks and bonds. Don't be, there's certain things we're going to talk about here in the course that are, some of the objectives, but don't get too overwhelmed with stocks and bonds. A lot of people, are very successful in personal finance and never buy individual stocks and bonds just because it's kind of an insider's game, to tell you the truth. There's a lot of people, who are tied to the markets and sometimes to the rest of us because we aren't there. You'll see the market move in inexplicable ways, and it's kind of unfortunate because there's reasons why it is moving, and it's just by virtue of the news. By the time it makes it public, is a lot of times already been acted on. Now maybe they're just smart folks and they anticipate it, but anyway, it's for a lot of people, it leaves kind of a bad taste in their mouth. You may decide to buy individual stocks and bonds, and it can be kind of fun. It can also be, a wise investment maneuver, but it's going to be something you'd have to pay a little bit more attention to and have a personal interest in it to make it successful. Now, that's not to say you won't be involved in equities, and usually we'll talk about mutual funds and other topics, but mutual funds, for the most part, they can be involved in a lot of things, but usually they're equities. They own stocks and they own collections of stocks. And within those mutual funds, you have a fund manager that you pay a certain fee to. And so it's his job to buy and sell these individual stocks that make up this mutual fund. So a lot of this stuff in terms of analysis kind of turned over to him, or her, sorry. But the way you would, select a mutual fund is with other documents and stuff. So you don't necessarily need to get down into the nitty gritty of how, what makes a stock desirable and what doesn't. So don't get too wrapped up about that. If you do want to do it as sort of a hobby, to get more involved and learn a little bit more about stocks, then, I encourage that. Or if you happen to, have a strong feeling about a company, it's dead easy to buy a stock. Buy stock in a company, especially with the new discount brokerages and stuff. So I encourage you to do that as well. But again, don't get too wrapped up if you aren't somebody who wants to run out and buy individual stocks. Okay, so what we're going to talk about tonight are some of the features of stocks, common and preferred, how to evaluate stock investments, analyze numerical measures, how stocks are bought and sold, and the trading techniques. It's good stuff. Again, these guys, though, they get really wrapped up between this whole common and preferred stock. Again, preferred stock has to do with treatment of dividends. For most people, especially younger folks, you're going to be wanting buying growth stocks, companies that are growing. Companies that are growing don't normally give dividends, so you don't care. You don't care about common and preferred stock because, for the most part, I encourage most of you, based upon your situation, to be buying growth stocks, and you're going to make your money through capital gains by that company growing and that stock price going up. So, don't think that, I'm going to go buy stock and I need to find preferred stock. You just don't come across it that often. And the difference between common and preferred stock, if a company's going to pay dividends, they have to pay the dividend to the preferred stock first. But if a company's in a position where they're not paying the dividends to all the shareholders, that company's probably struggling a little bit. So, again, they talk about common and preferred, and I'm just really, it's just not that relevant. How to buy stock and what you're looking for, something about the company, it always helps. But again, I made a ton of money on Twitter, and what's it got? It was, people were just trading on emotion. Amazon's kind of the same way. Earnings, things like that, they weren't there, but people still made a lot of money. So again, that's where some of the traditional valuations, especially when there's a bubble type situation, which a lot of people that arguably say we're in, it's tough to get those evaluations. So anyway, gather information, evaluate a potential investment, learn what the information gathered means, and yeah, stocks, periods where it declines in value, periods where it grows. It's a lot of times in equities, you're in it for the long haul with most investments. If you're going to be doing these things that are really super volatile and speculate, I've done it tons, but I've also, I'm probably at a net loss on the real speculative stuff. But that's not where most people make their money. Most people that are getting like say 8 to 10% per year, a reasonable return, actually quite reasonable, but that's over the long term. But this get rich quick schemes, well, that's it also works the other way where things go to nothing. So anyway, work for you over the long term, and that's the deal. If you're in it for the long term, like I said, in the stock market, you don't lose money if the stock goes down unless you sell it. If the company goes all the way broke, then you just walk away from it. But that doesn't happen very often, and especially if you're in a mutual fund type situation where you've got a collection of companies, then if one company goes out, somebody else is going to probably take up the slack in that sector, and so things even out. Why do corporations issue stock? So they raise money. Like I say, they could go to a bank, but again, why do that when there's people out there who want to invest in the company? So and then you end up with a primary and a secondary market, and so the corporation will sell stock, but when you go to buy stock from a broker or whatever, you're typically not buying it directly from the corporation. It's stock that's already been bought by somebody else or a big bank, and you're now trading around in the secondary market. And the secondary market is what gives you the liquidity of the stock, because that market is out there, and it gives you a vehicle to buy and sell. Dividends are not mandatory. Most corporations dividend, that's a bad characterization. Companies that pay dividends, but again, growth companies, which a lot of companies are doing, they reinvest it, okay? And when a company's reinvesting, then they're typically not paying a dividend. You can make money three ways. Okay, income from the dividend. So let's say, I keep talking about growth stocks. Well, let's say categorically, when you're getting closer to retirement, you might be looking for income. Okay, so you might pick stocks like the big blue chip, like a General Electric or somebody like that, who's possibly paying a dividend. Okay, and then you're getting income from that, and you're living off those dividends. The dollar appreciation of stock value, that's all the money I ever made in the stock market is from that. You buy the stock for $30, it goes to 45, you made $15 a share. No dividends were ever paid. Possible increased value from stock splits. That is, we'll talk about that, but there's just because a stock split, there is no income generated. What happens is a company will say their shares are selling for $50 a piece. All of a sudden, the stock goes up to $100 a piece. Well, they wanted, just for ease of sales, and they wanted a stock that's in a smaller unit of, say, $50 a piece. So what they'll do is they'll have a stock split, and they'll take that $100 a share stock, and they'll split it in two. So if you had one share at $100, after the split, you now have two shares at 50. Did that generate any wealth, any income? No. And so this is kind of a misnomer, but what it does do is it does show if a company's splitting their stock, it usually shows that company's got some momentum, where the stock price might be appreciating. So you might generate some interest and generate more buyers for a stock, and then supply and demand, the stock price will go up. But the actual splitting of the stock, that did nothing other than half it. So their next definition, divided into a larger number of shares. So again, no wealth is actually created there. It's just a split. But it does generate buzz, and buzz and media attention. That's good, especially if you own that stock, because it's going to draw more buyers and everything. And economics is supply and demand. Preferred stock, middle investment, ownership position, cash dividend before common stock. Investors need more predictable source of income, will choose preferred rather than common. Again, I don't think these guys trade a lot of stock, because I just don't see that much preferred stock out there, and I'm just not somebody drawn to income stocks, because I am probably a little, more aggressive, and probably in the same place though a lot of you should be if you're trying to generate wealth for some nest egg for later on in life. You probably aren't in income stocks, and again, maybe later in life you'll be fortunate enough to still be generating wealth. So again, you don't necessarily want to be in income stocks, because what's that going to do? That's just going to increase your taxes. So again, it depends on your stage in life, but they give undue explanation here to preferred stock. Cumulative preferred stock just means those dividends accumulate and then they're paid before they're paid to the common stockholders. Convertible preferred stock can be traded common stock in the same company. Again, common stock is they're acting like it's a bad thing. It's what most stock is just stock, and preferred stock is a unique case. This stuff is important though. These are terms that you hear a lot. Okay, blue chip stocks are the big, like when I say General Electric, and we used to be able to say GM and other things, but things change. Ford's probably blue chip. Anyway, you get some of these big stocks that are kind of the bellwethers. And then you get cyclical stocks, and those are ones. You get some energy stocks and other things that tend to go up and down. In a cycle, they go with the business cycle or they go with the energy cycle. Defensive stocks, when you're expecting things to get worse. Again, it's a characterization. Growth and income are two categories that you hear quite a bit. Growth stocks would traditionally not pay dividends because they're companies that are, moving on up. And then income stocks, income would be ones that are paying dividends. Okay. Then you get into the other types of classifications where large cap, large capitalization, big money. There's dollar terms that are associated with that, but just think of a large company. Mid cap, mid-sized company, and small caps. Small caps, a lot of times I'm drawn to them because, if they're a growth stock, they're probably moving on up, and so they start out as a small cap. Micro cap, now we're getting more into speculation a little bit. Micro capitalization, very small capitalization. And penny stocks are garbage. They're exciting, but penny stocks are literally, they're stocks that trade for pennies, and they're, especially with the internet now, it's there's so much hype out there. People say, oh, this stock's going. Well, it's probably a guy who owns that stock, and he bought it for a penny, and he's hoping it's going to go up to 2 cents, and he's going to double his money. So trying to get good information. They're usually unregulated. If you liked Wolf of Wall Street, you'd like penny stocks. But remember, the investors are the ones who are not making money on that thing. It was only the salespeople who were making money. Internet, evaluating a stock issue. Most corporations have a website. Website's easily accessible, Yahoo, Internet. Okay, so everything from Standard & Poor's on up is kind of garbage. The problem is when you're going to go to a company website, it's going to be very, kind of one-sided, as it should be. It's the company. So there's no comparison going on. It's individually, it's what the company wants to portray themselves as. And then Yahoo, I might get stock quotes from Yahoo, but again, it's not somebody I trust with information advice. Now, you look down at those sites on the bottom, Standard & Poor's, Value Line, and Morningstar. these guys, this is their bread and butter. This is what they do. They evaluate investments. So, you know, the corporate websites, they can't be misleading, and they've got the SEC out there that will prevent them from actually lying or misstating things. But just the same, investments are only the information is only valuable if you've got something to compare it to. So to do the side by side comparison of companies, you can't do that from a corporate website. Yeah, I mean, you could look at it to see what they're interested in, what they, whether their goals seem to mirror what you think. But again, it's written by a PR guy, and it's going to be, soft and fluffy and maybe misleading. So, stock advisory services. Again, these same people, they charge a fee for service. So again, you get what you pay for. If you're using a free service, might not be the best. Standard & Poor's, Value Line, Morningstar. Again, if you're going to make this decision and do it on your own, probably money well spent, tax deductible. There's a thing called the Motley Fool. They're kind of a stock. They're investment guys, and they have kind of a light approach to it, but they make some money. But their stuff is subscription based as well. And I've used that before and got some pretty good information. But again, it's based upon their analysis and numbers, and that's what you're paying for. If you use something like Money Magazine or something like that, a lot of times you're chasing historical data. They'll tell you what the fastest growing stock was last year or whatever, but a lot of times things have got nowhere to go when they're at their very top. So they aren't as good in predicting. That's why these other folks, Standard & Poor's and Morningstar, Barron's, those folks are better. Newspapers, they're kind of gone the way of the dinosaur. So the online editions, but again, that's more or less just for checking quotes. Wall Street Journal still good, and in order to check a stock, you could just as easily go to Yahoo, and that's something maybe to get from Yahoo or any of those kind of services where you just type in the ticker and it'll give you a chart and the price and all that kind of stuff. That's easy. Ticker symbol is, well, it doesn't have to be, like Ford, I guess, is just F. But other ones are usually more, indicative. A couple letters to let you know what the company is, and it's just an abbreviation, but it'll give you a stock price. Corporate news. So when you get in the SEC, the direct information from the SEC or the annual reports. Again, annual reports, they're not comparing, company to company. Now, if you've got two annual reports and you've got the knowledge and you set them next to each other and you make those comparisons, that's valid. The SEC stuff, again, it's almost like needing information on your taxes and going to the IRS forms. It's going to be accurate, but it's not normally going to be in a user-friendly format. So that's where, Standard & Poor's and these other folks who put together these comparative reports, they get their information from here, and they kind of refine it, analyze it, and put it in a more user-friendly format, and they tend to key in on what's important and what's not. So might be a better way for you to go. Numerical measures of influence. So corporate earnings, definitely, yeah, but if you're trying to buy a stock based upon earnings, a lot of times there's estimates out there, and you'll see a stock price. You'll see a company lose money and their stock price goes up, and you're like, how can that be? Well, it's because the street, the people out there thought that the price was going to go the other way, or they knew it was going to be bad, but they thought it was going to be worse. So it's very counterintuitive, and you will drive yourself nuts trying to figure it out, because there's some very smart people who are spending a lot of time on this, and they're driving the market a lot of times before you get to the market, especially in Alaska. The markets open up quite a bit earlier. They're going to be closed by lunchtime, Alaska time, by noon. So earnings per share. So easy to calculate. Earnings per share, price to earnings ratio. So price to share divided by the earnings. So you'll see P ratios and EPS. Those numbers will be valuable. But again, if you're going to be trading individual stocks, a little bit of knowledge can be dangerous. There's more to it than just those factors. Dividend payouts, are they paying out? And use earnings per share on that, and dividend yield. Again, I don't typically deal with income stocks, so I'm not saying income stocks are bad, but again, if you're in the income earning years, your investments are generating wealth for kids' college, for your retirement, and to be, whatever amount of money you're making now, to be getting income from your investments, unless you're using it, well, you shouldn't be using it. So it's just going to be an extra tax burden. So most people don't want to reinvest their dividends anyway, and that's always an option to have them buy more stock with your dividends rather than pay them out cash and generate a tax burden for you. Other factors influence the price of stock. So dividends, capital gains. So again, for the equation I usually use, it's just capital gains. But if I was getting dividends, that would be in there. Annualized holding period. So again, they're just using the time value. You made so much per share over so many years. How much did that work out to per year? And you can get a rate. The beta. So beta is pretty important. If somebody says it's a high beta stock, it means it's pretty volatile compared to the S&P. So what's the volatility of the Standard & Poor 500? 1. Okay? So if something's, a 2, that means it's twice as volatile. If it's 0.5, it's half as volatile. So a high beta stock is good for me. I mean, I think it's more exciting and moves around, and if you're going to get in and out, but know what you're getting into. If you're not into a thrill ride, then you want a lower beta type stock. You want something that's going to be less volatile. Book value per share, assets minus liabilities divided by the shares outstanding. So, and again, some other simple. If a share costs more than the book value, if you do these sorts of calculations with something like Twitter or Amazon, you're going to say, well, why would anybody ever buy it? But people do, and people make money. So, market to book ratio. So, undervalued stock, overvalued stock. In a perfect market, the market is going to set these prices. Fundamental theory. So different concepts relating to the market. Stock's intrinsic or real value is determined by the company's future earnings. Stock prices should be a measure of the company's future potential, not necessarily their current potential. So financial strength of the company, industry, new product development. So it's very forward-looking, right? Technical analysis, supply and demand, not based on expected earnings. Charters plot price movements, observe trends. These guys will drive you nuts. I mean, obviously, any one of these approaches alone is probably not ideal. But some of these folks will just look at charts and make assessments in terms of where the stock price is going. And there are people who just use charts to do that. That's very technical. And then efficient market theory, it's that's just a understanding that it's just kind of out of control, purely random. It's impossible for an investor to outperform an average stock market as a whole over a period of time. I don't agree with that. So anyway, I would, if I had to pick just one, I would probably go with the fundamentalists, go forward looking based upon the strength of the company. Okay, so this is what I talked about with the primary and the secondary market. So a company says they want to sell stock. Do they normally offer to the public? You can actually buy stock, especially if you work for the company or there's a direct stock purchase program. Corporations will do that, cut out the middleman, but doesn't happen that often. Usually it goes to an investment bank, but everybody gets a little something for the effort. so the price tends to go up. IPOs, initial public offerings, man, when you hear something's coming out like Alibaba or Twitter or something comes out, oh, it's going to come out for $23, and then by the time you can buy it, it's up to 53. It's like, again, that's what kind of drives people away from the stock market, because the only people to get those kind of sweetheart deals on that low price stock were kind of insiders who they owed something to. So again, it can be a bit frustrating, but that's an initial public offering when a company's first going public. Secondary market, this is where most things get traded, So the stock's out there and it's just floating around. It's when you buy stock, you normally don't take the actual documents to it. I've never had a stock certificate, and I wouldn't want it because it'd be dangerous. The financial institutions hold on to those things somewhere, but they're probably even virtual at some point. But anyway, in a secondary market, people are buying and selling, say Ford or whatever stock, but Ford's not involved anymore. It's just that stock's out there floating around and it's being traded back and forth by other people. So traded amongst investors through brokers. Getting a broker is no big deal, and you can sign up and start trading stocks, and under $10 a trade is kind of the standard now, and it's easily done. But anyway, when you get to that point, it's don't be hesitant. You can buy some shares and see how it works, and then maybe some point get more deeply involved. The security exchanges, this is where this stuff happens, the secondary markets. So this is a good thing, the New York Stock Exchange is what gives liquidity to the market. NASDAQ, over the counter, OTC, that's what they're talking about there, electronic marketplace. So again, you don't have people down there in pits or whatever, it's just done by computers. And that's becoming more and more popular. NASDAQ has got a lot of high-tech companies, a lot of smaller companies come out there. Maybe move up to New York Stock Exchange, maybe not. But there's stock exchange all over the world, but they're all just secondary markets. Brokerage and account executives, I've used to have these guys, and I think every time I got basically ripped off. I got a letter from, some lawyer saying there's a class action lawsuit that these guys were pushing stock that they had an interest in or they knew was overvalued, and so I've, most people just work direct because that's the only way you're going to trade stocks for $8-9 is to do it electronically and without a broker. So you can always get an account executive, but again, they're the kind of salesman folks, and the value added is questionable. So that's what they're talking about here: discount broker versus full service broker. And the full service, I got serviced. It wasn't a positive, client relationship, and they weren't offering advice, and the advice they did offer, I found out later, was biased. So again, plenty of folks, and again, if you're looking for mutual funds, you might find that under there's a subset of that company that has a brokerage where you could actually trade stocks directly with them. So when you are going to buy stocks, and this is what does have a bit of advantage over mutual funds. Mutual funds, say you want to sell mutual funds, they're going to sell them at the end of the day, at the closing price. Stocks, you buy and sell within the day. So, you get the price that's there right then. And if you say, I just want it right then, that is a market order. A limit order means, okay, the stock's trading for $31, but it's zooming around. I'm going to buy at $30. And if it drops down to $30, boom, you jump in with the anticipation that hopefully it's going to go back up. A stop order, let's say you're making money. I did this with some Twitter stuff. Let's say Twitter's trading for about $50. I'm feeling pretty good about that, but I'm going to put in a stop order to sell at 45. If the market falls out, I want to have my stuff sold at 45, so at least I will have locked in some profits. And then you can get very elaborate where you go, okay, I'm going to have like a trailing stop, and if I'm going to keep my sell price, my stop order, about $5 behind. And again, it's all relative, and you have to come up with these limits yourself. But if the stock keeps marching forward and you have this trailing stop behind it, then it can go to 60, 65, 70, and your stop is following along. And then boom, when it drops, you're out and you made some money. Again, it can get a lot more complex, and most people have jobs, kids. They don't have the time to watch it like that. But there's people who do, and they do well. But anyway, they can also lose quite a bit. Long and short-term strategies. Most people are kind of buy and hold. Dollar cost averaging, that just has to do with I'm going to buy, $100 a month of certain whatever. Every month when the stock price is low, I'll get more shares. When the stock price is high, I'll get smaller shares. But it's this, they're people who don't believe in market timing. And they probably do pretty well. A lot of times it's more appropriate for mutual funds, because mutual funds, the prices, you buy shares, or not shares, you buy dollar amounts, whereas in stocks you buy individual shares. DRIPs, dividend reinvestment plans. So again, rather than direct investment, where you have the money automatically come out. Short-term techniques, day trading, buying on stock, don't do it. Selling short, borrowing stock, predetermined trading options. All these things are pretty advanced. You can lose money you don't have, quite easily. And day trading, some people will convince themselves they're great day traders, but it's an up market and the minute it turns south. Anyway, I don't know too many successful day traders. So all these short-term techniques are kind of beyond the scope of what I call personal finance. They're more into speculation. All right, so that was kind of the quick and dirty on stocks. Now we'll talk a little bit about bonds. Bonds, okay, characteristics of corporate bonds, why they issue them, federal, state bonds, evaluate bonds. So, written pledge to repay money, so it's kind of a loan. You aren't buying equity, you aren't buying a chunk of that company, you're financing a loan for them. And so, it's you loan them whatever amount, in usually increments of 1,000, and then you will pay them. They will pay you your money back, and then they'll pay you a dividend along the way. So you give them $20,000. They'll give you 2% of $20,000 up until the maturity date, and you get your $20,000 back. It's a fairly simple concept. Every 6 months, bond indenture, and a trustee acts as the bond. So you're not dealing directly with the company. There's a trustee involved. Why corporations issue bonds? So they're gonna build something. They may not be able to sell stock. They want to dilute the company anymore. There may be some tax reasons, but they're not diluting it. Debenture, unsecured, backed only by the reputation. So if the company goes underwater, you don't have collateral necessarily. It's only the company is it. There's no FDIC or some government entity that's going to step in and make you whole. Mortgage bond, secured by the assets of the firm, usually real estate. Interest rate is lower because it's secured. But again, the security is, especially in real estate, people find out that it's not as big. Subordinated, not a good thing. Unsecured bond, claim of secondary mortgage with respect to interest, and convertible can be exchanged for common stock. So convertible bond can be converted into stock at some point. High yield bond, you're used to hearing junk bonds, that's what these are. The reason why they're paying high yield, it's like interest rates. If they're paying a high yield, there's a risk of default. It sounds better than junk bond, but it's the same thing. Call feature just means that they can say, you know what, the interest rate situation's changed. We're going to call that. We're no longer going to guarantee pay you, 10% interest for whatever number of years. Interest rates go down. We no longer want to pay that anymore, so we're just going to take it back. So you don't get your interest. So, but you knew that the bond had a call feature when you bought it, so it was a risk you took. Sinking fund, this is just how they're going to pay this money back. So it's a fund for them to give you your, say, your $20,000 back at the end of that term. And then serial bonds, they issue them in a series, different dates. So you'll have, different expirations on different dates. They'll time out in a series. Why investors purchase bonds? Well, right now, there is no good reason to purchase bonds, to tell you the truth, because interest rates are low. As interest rates go up, the value of those bonds is going to go down. So, but anyway, in theory, if interest rates were normalized, if they're in a normal range, you'd get this interest, and then you get your money back at the end. So they can be a good investment, but right now, the financial situation with interest rates being low means that they're not typically a great investment right now. Dollar appreciation, and then that's longer term bonds. Shorter term bonds might still be attractive because the interest rate changes are probably not going to be that drastic in the short run. So anyway, dollar appreciation of bond value. So let's say you buy a bond, a $20,000 bond that's going to pay 2% interest. You can sell that bond. You don't have to keep it till 20 years. But this is where the value of that bond is going to change based upon what the prevailing interest rate is. If the interest rates go up and people can now get 3 or 4%, well, your terming bond that's only paying 2% isn't worth as much. So when you go to sell it, are people going to give you the face value for it? No, they're going to give you some lower amount. So that's the problem. Mechanics of a bond transaction. So you can hold it. You can, say I'm going to get my 2% and I'm going to hold it for 20 years. But if you can competitively get 4 or 5% in the market, let's say interest rates went up, why would you want to do that? So anyway, everything's going to be taxable, and you buy them through firms or on the internet. A lot of different ways to buy them. Municipal bonds, state bonds, they do it to fund investments. But again, people go, oh, tax-free bonds, that's the one I want. Well, no, you have to keep in mind that this is all calculated in. You're going to find municipal bonds are going to be paying a lower interest rate than a taxable bond. So, the investment companies, it's all a competitive, market-driven investment. And so, a municipal bond will be paying, 1-2%, and a taxable bond be paying 2 or 4%, and that difference is based upon the tax that's going to be paid. So don't fall in that trap. T-bills, T-notes, we're kind of familiar with this. These are just government-issued bonds. But again, if you remember from the interest rate section where we talked about investments, the rates on these are laughable. They're very secure, but you are going to in most cases be losing money when you factor in inflation. Treasury bonds, so a little bit bigger, maturities of 30 years, minimum units of 100. So, and you got T-bills, T-notes, held until maturity or sold before maturity. So, not a great statement there. Tips: Treasury inflation, because they know inflation's working against you. Again, value will vary, but it's a little bit more complex vehicle, but the rate's going to be a little less because it's protected against inflation. And then the federal debt issues, this stuff used to be rock solid, and then all the stuff in 2008, 2007, and some of these companies were not nearly as attractive as they once were. But, when you hear Fannie Mae, Ginnie Mae, these are all government things, and they're just, Federal National Mortgage Association. Fannie Mae is what they call it. Freddie Mac. So slightly higher than treasuries, so slightly higher risk, so slightly higher interest rates. And callable before maturity. And then when we get down to munis, it jumped a slide there. Investing close to home, may be callable, but not until 5-10 years generally. Interest may be exempt, but your interest rate paid is going to reflect that. And again, we know how to do the calculations, and be aware of how to do that. That's assuming a 28% tax rate. That's where they're coming up with that 0.28. Yeah, the internet, you can get good information and bad information on the internet, but if you, I don't like any of these .com type sites. I would go to your standard rating type agencies that are actually in the business, that are not, the annual reports, again, don't give you the comparative data, but these folks here, Moody's, Standard & Poor's, Fitch, that's where you get information on ratings. Because unfortunately, some of those .coms may be influenced by the companies who are issuing the bonds. You may get some bad information. And you get these bond ratings, which are, AAA, obviously good. D, we're getting off into the realm of junk. Bond yield calculations. So current yield on a corporate bond is the annual income amount divided by the current market value. Easy. How to do that calculation? So amount of interest, face value, number of periods, market value plus face value, you divide that by 2. Okay, and the term project. So again, bonds, I don't mean to gloss through bonds, but at least for the next couple of years, until you see interest rates get back into a normal range, we're not going to be, anybody who's suggesting that you buy long-term 20-year, 30-year bonds, I would find a new advisor at that point. But the term project, so again, I hope you're making some progress on that. We're looking, at a point in your life. It could be now, or it could be 5 years out if you're not really, if you're a traditional college student. But what you're looking at is where are you going to be at when you have some money? How are you going to start investing it to prepare? You may find it useful to use real numbers, but don't tell me whether it's real or fictitious or whatever. Just use whatever numbers you want. And again, it's for most of you, it's just going to be a kind of a guesstimate anyway. But what you're going to want to do is set yourself up for financial success. So, that'll be done, accomplished, and the format's flexible. 4 or 5 page paper, double spaced. But typical goals, depending on your situation. But those goals would include, college, retirement, what happens in terms of, death or injury. So we're talking life insurance and disability insurance. Student loans, is that going to slow you down? That's a problem right now. A lot of folks have got, they're laden with student loans, and so when they should be investing for retirement, they're still paying off student loans, and now they're, up to their 40s. That's a problem. You don't have enough time. You need time value of money. Social Security on it, I encourage you to look at how much of that would be or how little that would be more accurately. It's going to have to be revised, but right now it's just the same. It's probably going to be means tested. So if you do have any income, you're probably never going to get it. So life insurance, I mentioned. Investment portfolio, what you plan to invest in, real estate, mutual funds, directly into stocks. Are you in a situation where you have a pension fund, military or some sort of union thing, or is it going to be one of these things where you're on your own, which is pretty much the norm now, where you got a 401k, 403b, thrift savings plan, something like that. But anyway, I just wanted to kind of highlight that the term project's going to be coming up, and it's time to definitely get that thing moving along if you haven't already thought about it. All right. So that's about it. No additional homework. Just start making some progress on that term project. I think my hard drive ran out of space last week. That's why the lecture just sort of cut off at the very end. But anyway, if you look on the slides, you can see what the homework was, and we'll talk more about that in the upcoming weeks. Otherwise, I will talk to you next week.